accounting standard 20, that is impairment of asset. So what do you mean by impairment? Impairment means permanent reduction of the value of an asset. So the main objective of AS 28 is to ensure that an asset is not carried at more than its worth amount. That is, in simple terms, it means that the value of an asset shown in the books should not exceed the amount that can be recovered from its use or sale. If it does, the asset is said to be impaired or and a loss must be recognized. So, the purpose of impairment asset is to get true and fair value of an asset in financial statements and to ensure that any decline in the value of an asset is recognized as soon as occurs. Any decline in the value of an asset is recognized as soon as occurs to prevent overstatement of assets and profits, to promote transparency and comparability in financial reporting. So, these four are the purpose of impairment of asset. To ensure true and fair decline in the value of asset is recognized as soon as occurs, to prevent overstatement of assets and profit, to promote transparency and comparability in financial reporting. So now we are going to discuss the scope of impairment of asset. Impairment of asset generally applicable to all the assets except certain cases. Impairment of asset applies to tangible fixed assets, intangible assets, and cash related these cases because these assets comes under other accounting standards. That is, for inventories there is another accounting standard, that is accounting standard 2, and for construction contracts accounting standard 7. So that is the reason why these asset does not come under impairment of asset. So impairment of asset generally applies to all assets except these cases, that are inventories, construction contracts, withholding tax asset, investments, investment property, and biological assets related to agriculture. If these six assets are the assets which does not comes under impairment of asset. Another thing we have to know is that AS 28 applies equally to individual assets and group of assets. Goodwill is also tested for impairment annually even if there is no indication of impairment. These are the two notes we have to keep in mind, that impairment assets applies equally to individual assets and CGUs, as well as goodwill is always tested for impairment even if there is no indication of impairment. Next, we are going to discuss important definition. Important definitions comes under impairment of asset, and we have to keep in our mind. First one is impairment loss. The impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. That is, for example, if carrying amount of an asset is 10 lakh and the recoverable amount of an asset is 8 lakh 50,000, then the impairment loss is 1 lakh 50,000. That is, here a loss happens. This loss is called impairment loss. Carrying amount is the amount at which an asset is recognized in the balance sheet after deducting accumulated depreciation and impairment loss. So, what is carrying amount means is that the value of an asset minus depreciation minus impairment loss is the carrying amount. And the third term is recoverable amount. Recoverable amount is the higher of the selling price and that is value used. So, the problem statement the loss appears. And second one is reversal of impairment losses in the so here we have to disclose how much previously recognized loss was reversed, and also just like here we also have to recognize how much loss is reversed, as well as in which part of the P&L statement this reversal appears. That is the second one. And third one is impairment losses recorded in the revaluation surplus. So surplus we have to directly deduct the amount from the revaluation surplus during the period. So in the case of surplus, we directly deduct the amount. So we have to disclose that as well as in the disclosure of impairment loss. And the fourth one is reversal of revaluation surplus. So in the case of reversal of impairment loss in the revaluation surplus, here we have to add back the amount to the revaluation surplus. So in the case of impairment loss, here we deduct the amount directly from the revaluation surplus. Here we have to add back the impairment loss to the revaluation surplus.
Hi guys, in this session we are going to discuss about the accounting standard 28, that is impairment of loss. In this previous class session, we have already learned about the theoretical part of accounting standard 28. In this session, we are going to deal into the calculation part. So, before learning about the calculation part of AS 28, we have to identify whether there is impairment loss or not. There are certain indicators which indicate that there is impairment loss or not. So, we are discussing about the indicators. These are the indicators. First one is external and second one is internal. External means the market value of asset declines significantly. If the market value of the asset declines, it is the external indicator. And second external indicator is adverse changes in economic, technology or environment. Is there is any changes happens to the asset because of the technology or legal environment or economy, it will comes under the external indicator. The third one is increase in the market interest rate, reducing asset value. That's it. In the internal factors, physical damage or the obsolescence of the asset, poor performance or decline cash flow from the asset, plan to discontinue or restructure the business using the asset. If any such indicators happens to the asset, we can say that there is an impairment loss. In the second stage, we are going. For example, a factory owns a machinery recovered at rupees 10 lakh. Due to new technology production using this machine has reduced and its market value dropped. Here there is a in the external indicator, that is technology, which leads to impairment loss. So we can say that there is impairment loss in case of the machinery cost rupees 10 lakh. Going to the calculation part of AS 28, we should be familiar with the certain terminology. So first one is recoverable amount. As you can see, net selling price or the value in use of the asset, whichever is higher, should be treated as recoverable amount. For example, if the net selling price is greater than value in use, the recoverable amount then will be the net selling price. As the net selling price is the higher amount, it should be treated as recoverable amount. If the net selling price is less than value in use, then the recovered amount will be the value in use. For example, a factory owns a machine recorded at 10 lakh rupees as its value of the machinery. Due to new technology, production using the machine has reduced and its market value dropped. So we have to give the information slide. They have already said that due to technology, the machinery has some decline in its value, and they have additionally said certain things like value of the machinery is 10 lakh and fair market value is 8 lakh 20,000 and value in use is 7 lakh 20,000. Fair market value simply means the net selling price. Fair market value minus cost of sale is the net selling price, and we have already directly given the value in use. So value of machinery is also known as carrying amount. minus 2 lakh, that is 8 lakh. So after comparing NSP and values, the higher one should be taken as recoverable amount. So we can see that the higher values, that is 9 lakh. So 9 lakh, whether there is impairment loss or not. For that we need to compare the carrying amount and recoverable amount. Here you can see that carrying amount is 13 lakh and recoverable we calculate is 9 lakh. So we can see that carrying amount is higher, right? So carrying amount is greater than recoverable amount. So which means there is a impairment loss. So we identified that there is a impairment loss. So next step is to recover amount from carrying amount. For that we have to look at the question. We can see that there is a depreciation. There is a depreciation. So we need to deduct this depreciation from the value of carrying amount. So 30 lakhs minus 1 lakh, which means 12 lakhs. 12 lakhs is the carrying amount. Now we can calculate the impairment loss. So impairment loss equal to carrying amount minus recoverable amount. That is 12 lakh minus 9 lakh. So 12 lakh minus 9 lakh equal to 3 lakh. So 3 lakh is the impairment loss. So next we are going to take the journal entries. So in journal entries, we are recording impairment loss amount. Letter to we know that it's a machinery, so it should be letter to machinery. The amount will be 3 lakh. Then the accounting treatment will be that this 3 lakh will be shown as expense in P&L account, and it should be deducted from the asset in balance sheet.
Hi all, today we can deal with cash generating units CGU. First we will with the definition. A CGU is the smallest identifiable group of assets that generates cash inflows from continuing use that are largely dependent on cash inflows from other assets or group of assets. Simply it means when it is not possible to determine the recoverable amount of an individual asset, the enterprise must assess a group of assets together that generate cash inflows independently. Now let's deal with steps in CGU, that is steps in CGU evaluating asset. The first step is determine the recoverable amount. Computing the recoverable amount, that is recoverable amount is higher of NSP step 1. Now step 2. Step 2 is comparing with the carrying amount. The second step is comparing with the carrying amount. Compare the recoverable amount with the total carrying amount of the CGU asset. Now let's deal with the third step, that is recognizing the impairment loss. Recognize impairment loss. If the amount is less than the carrying amount, it means there is the asset or CGU is expected to generate sufficient future economic benefit to recover its book value. So the difference between the carrying amount and the recoverable amount is called the impairment asset. The fourth step is allocation. Fourth point is allocation of impairment loss. If loss is there, first is we can allocate to goodwill if any, and then other two assets proportionately according to that carrying amount. Next topic is goodwill and corporate tax. Goodwill and corporate tax are tested especially under age 20 because they do not generate independent cash flow. The first one is goodwill. Goodwill represents the future economic benefits arising from assets that are not capable of being individually identified or separately recognized. It usually appears when one company acquires another, or when reputation, brand value, customer loyalty, or synergies add values. For example, A limited company acquired B limited and recorded goodwill as rupees 5 lakh. The asset of the CGU goodwill including 25 lakhs. And recoverable amount is 20 lakh. So here the impairment loss is 25 minus 25 lakh. Now this loss is to be allocated first to goodwill. That is the 5 lakh should be written off in goodwill account. The treatment of the journal entry is impairment loss account letter to goodwill. Next topic is corporate assets. Corporate assets are shared assets that benefits multiple CGUs. They are usually shared assets that benefit the entire organization, such as head office building, general R&D centers, main IT data system, etc. They do not generate independent cash flow. Nor can their value be directly allocated because they contribute to many CGU, not just one. Their value cannot be divided fairly between units. The next topic is reversal of impairment loss. After recognizing impairment, the asset value should be reviewed at each balance sheet date. If circumstances improve and recoverable amount increases, the previously recognized impairment loss may be reversed. Now, when the reversal of impairment loss is allowed, it is allowed only when there has been a change in estimates used to determine recoverable amount. For example, market value of assets has increased, technology or legal environment has improved, business performance is better than expected, discount rates have fallen. Now, when reversal of impairment loss is not allowed, if improvement is merely due to passage of the unwinding of assets, the treatment is asset account letter to reversal of impairment loss. environmental obstacles. Now
Start.
we can test the two-level environment test. First one is top-up test. Bottom-up test. First test each individual CGU for impairment, that is excluding carrying amount. Recognize impairment if any for each CGU separately. The second one is top-down test. Here it includes carrying amount and test a larger group of CGUs together. Determine the current amount of the combined units. If the larger unit is impaired, allocate those to individual CGU based on the relative carrying amount. The allocation of first to goodwill, if any, or assets, other assets proportionally.